I think in terms of supply chains, obviously we've had these disruptions recently. So I think we want to keep an eye on that, make sure that they don't get any worse. And I think we're in a good place with them, that they should be manageable and not have too big of an impact on the economy.
You're listening to IBKR Podcasts. Find more conversations at ibkrpodcasts.com. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show.
Hi, everyone. Welcome to IBKR Podcast. I'm your host, Jeff Praissman. It's my pleasure to welcome back to the IBKR Podcast studio, Nasdaq's U.S. economist, Michael Normyle.
Thanks for having me back.
Oh, my pleasure. How are you doing?
Doing well, thank you.
It's always great to see you on our monthly podcast on economics that we do together. And, today is no exception. In the past, we've talked about PMI and supply chains. But today we're actually going to kind of dig down deep and discuss how they relate to each other. So I'd like to start with, for our listeners, a refresher on the PMI. Can you tell them, what exactly is the PMI and why is it useful?
Yeah, so PMIs are purchasing manager indexes. They're a survey of purchasing and supply executives, generally within a specific region and industry. So typically at the country level and often divided between manufacturing and services. And so when you look at a PMI, a reading below 50 generally means that activity is contracting, and above 50 signals expansion. And so it's useful because it provides insights from decision makers within that industry, and because it's timely. So we often get flash or preliminary PMIs by the third week or so of the month. So for example, by late April, we already have an idea of what the PMIs are looking like for that same month. The final PMI is then released at the beginning of the following month. But by comparison, the kind of hard data for manufacturing, for example, like industrial production, you wouldn't get the April reading until the middle of May. So markets like that, it's a really timely indicator of what's happening in an industry. And then on top of that, there are sub-indexes that give insights into specific areas like demand for new orders or prices paid by these purchasing managers, and as well as employment. So it could be really informative. So if you take the ISM manufacturing PMI for the US, that's derived by applying equal weights to the sub-indexes production, employment, supplier delivery times, and inventory change.
You kind of mentioned really quickly in the beginning of the explanation, we hear PMI a lot in the news, and I think a lot of people may just think it's U.S. specific, but really you had specifically mentioned, region or country. So there's PMIs for different countries or different continents, correct? There's like a Eurozone PMI, and I would assume like a China PMI, and it's not just for U.S. And I think that's kind of important to point out to our listeners.
Yeah, there's a lot of PMIs. So not only by country like US, Canada, China, and like you said, by region for the Eurozone. And then within the US, the regional Fed banks also have their own PMIs. So you can get, like, for example, for the New York Fed, there's the Empire State Manufacturing PMI. So it can get even more granular, at least for the US.
That was for US. What about the Eurozone and China? Is it just one PMI for each, or do they have the manufacturing and the more kind of granular PMIs as well?
Well, of course, for Europe, there are country level PMIs available that can be aggregated and stuff like that into the Eurozone. Of course, the UK has their own PMI. China, like the US, has two PMIs. There's an official PMI and then a private PMI. So, people look at both of those.
And, for the U.S. PMIs, what have they been signaling for the past couple of years? And, were they correct?
Yeah, so I think the last time we talked about PMIs, we were talking about the two-speed economy that they were signaling. So the services sector was expanding, the manufacturing sector was contracting. And so for the U.S., there's two main PMIs, one from the Institute for Supply Management, or ISM, and one for S&P. And so they've got different methodologies, so the results are a little different, but both have generally shown that the U.S. manufacturing sector has been quite weak over the last couple of years. So starting in late 2022, the ISM manufacturing PMI fell below 50 and stayed there for 16 months. At the same time, the S&P manufacturing PMI fell below 50 and stayed there for 13 out of 14 months. So both were clearly saying the manufacturing sector was contracting. But that was more negative than the hard data showed. So manufacturing output, as measured by industrial production, more or less moved sideways instead of contracting, and manufacturing employment actually rose a little bit.
What has the PMI recently been signaling for the U.S. manufacturing sector?
So the PMIs have finally turned around. The ISM PMI just rose above 50 for the first time since October of 2022 in March, but it's also been trending up since late last year. S&P PMI has been above 50 for 3 straight months, and it's been in an upswing since mid-2023. Although the preliminary reading we got for April did just dip to 49.9, so just below the expansion-contraction threshold. But we'll have to see if that gets maintained in the final reading that we get at the start of May. But right now, both have clearly been trending up, and the last final readings that we have for both are above 50, signaling expansion for the manufacturing sector.
And Michael, what about the Eurozone and China?
So the S&P manufacturing PMI for the Eurozone, it's still well below 50. It's at just 45.6. And it's been under 50 for nearly 2 years. However, it has generally trended higher since mid-2023. So basically that means that the manufacturing sector, it's still contracting, but slower. The UK manufacturing PMI, though, did just pop above 50 for the first time in a year and a half in March, although like the US, the preliminary April reading is just back below 50. So we do see that the manufacturing revival, it's still kind of developing in Europe. In China, there's, like I mentioned earlier, 2 PMIs. And so the official PMI just moved back above 50 after 5 months in contraction. And so the manufacturing contraction in China was much shorter than the ones that we saw in the US and Europe, where they were, 1.5 to 2 years, basically.
Kind of going back to the manufacturing sector, obviously, manufacturing takes supplies. How have supply chains been over the past few years? Have they been operating efficiently worldwide, or have they, kind of run into some issues based on kind of predictions or based on outside factors such as, I know we're a little bit past COVID, but, sort of obviously a huge factor in everything.
Yeah, so the last few years have definitely been a tough period for supply chains. So for a few reasons. First, COVID, like you mentioned, disrupted supply chains. So lots of factories had to shut down early on in the pandemic because being in such close proximity made it easy to spread COVID. And then even once factories were able to reopen, you, of course, had workers in and out with COVID. And then there was also the Great Resignation kind of period that impacted factories, certainly. And then there's also the demand side where, at least focusing on the US, when everyone was locked down, there was a jump in spending on goods relative to pre-COVID levels, since people couldn't spend money on services as easily. So there was this big increase in demand at a time when supply was constrained. And so that really stretched supply chains, making it difficult to get things as simple as shipping containers to move goods around the world. But as economies reopened and people shifted back to spending on services, supply chains have healed. So, of course, we're still seeing some disruptions, including from geopolitical events like the attacks in the Red Sea, meaning that shipping containers avoid the Red Sea, resulting in longer shipping times. And then also you had the key bridge collapse at the Port of Baltimore recently. But compared to COVID, these have been much more manageable for the supply chain. So they've really healed pretty significantly from kind of peak disruptions that we saw a couple of years ago.
Besides for actual disruptions, such as the Red Sea or the bridge collapsing in Baltimore or even COVID, what about kind of the relationship, the perceived, or maybe, and you mentioned earlier that the PMI kind of overstated the slowdown in the past couple of years. How does that affect the supply chain? Do companies purposely lower employee count or slow materials down in order to prevent, having too much in stock and kind of lowering the price that way?
Yeah, I think we've seen a shift in kind of inventory management, supply chain management from pre-COVID to post-COVID. So pre-COVID, supply chains were really designed to be just in time, was what it was called. So, Walmart was a big kind of pioneer in that, where companies tried to keep inventories low and their suppliers were able to see speed of sales, inventory levels, and things like that so that they could predict what would be needed and get it there just right when it's going to be needed. Since COVID, though, there's been a shift to kind of just-in-case inventory and supply chain management, where companies want to build a bit more of a buffer into their inventories to avoid those shortages that were faced during COVID. But either way, in both cases, it's still about predicting demand. And with just-in-case, you just keep a little bit more of a buffer. And of course, there's no perfect forecasting, so there will always be cases where maybe a company has too much of something and too little of others.
The last time we talked, as you mentioned earlier, we talked about this manufacturing economy versus the service economy. How currently is the manufacturing, economy doing compared to the service, economy? has it made some strides to kind of level up a little bit, or in fact, their overall contribution to the U.S. economy?
Manufacturing, it's really quite a small piece of the U.S. economy, and that's really a decades-long downtrend that we've seen in the share of the economy coming from manufacturing versus services. So if you look at gross value added right now, manufacturing is just 11% of the US economy. And actually, even fewer jobs are in manufacturing. Only 8% of jobs are in manufacturing. In comparison, services, it's nearly 80% of gross value added and nearly 85% of private sector jobs. Over the last few decades, we've seen a lot more people moving into the service sector in terms of jobs. Of course, there is also all the movement of manufacturing jobs out of the country a couple decades ago. And then, of course, the mechanization of manufacturing requiring fewer people to be employed in manufacturing.
How about the Eurozone and China? Are they following the same trends as the U.S., or are they... you always see like made in China, or is China just still manufacturer heavy, I guess would be the question.
They're definitely a bit more services oriented than manufacturing, but manufacturing is more important in the Eurozone and China than in the US. So in the Eurozone, manufacturing is 15% of gross value added compared to 11% in the US. And services is 2/3 of gross value added for the Eurozone. And of course, within countries, there will be some variation within the Eurozone. But in China, manufacturing is nearly 30% of gross value added. So close to triple what it is in the US. And services are only about 50% of gross value added.
Looking further down the road, what are the PMIs signaling for the U.S.?
So both the ISM and S&P PMIs are in upturns and they're above 50. So we should expect the manufacturing sector to pick up. But since they're both kind of just above 50, we shouldn't expect a strong rebound in manufacturing necessarily just yet. So it's still a kind of a modest upturn that they're signaling right now.
How about for the Eurozone and China?
It's a similar story for China. Its PMIs are pointing to a rebound in manufacturing, but again, we should expect it to be relatively modest for now. For Europe, the manufacturing rebound is still developing, but it's important to mention that this is actually a global story. The global manufacturing PMI turned up in mid-2023 and has been above 50 for 2 months now. So we're seeing a global recovery in manufacturing too, beyond just Europe, China, and the US.
Michael, this was great. I want to thank you for stopping by our IBKR podcast studios. Is there any final thoughts you want to leave our listeners with, regarding PMI and supply chains?
It'll be interesting to see if the upswing can continue in the manufacturing sector, especially within the U.S. If we get kind of instead of the 2-speed economy we were talking about before, we can have a 1-speed economy where they're both going in the expansion direction. So that's something to watch. And I think in terms of supply chains, obviously, we've had these disruptions recently. So I think we want to keep an eye on that, make sure that they don't get any worse. And I think we're in a good place with them, that they should be manageable and not have too big of an impact on the economy.
And for our listeners, for more from Michael and Nasdaq, please go to our website under Education to view previous Nasdaq webinars as well as previous podcasts. Thank you for listening. Until next time, I'm Jeff Praissman with Interactive Brokers.
Thanks for listening to IBKR Podcasts. As always, we have more episodes at ibkrpodcasts.com. And if you're interested in learning more about Interactive Brokers, visit ibkr.com. We offer more trading education material, such as webinars at ibkrwebinars.com, financial and economic commentary at tradersinsight.news, market-related courses at tradersacademy.online, and quant-related articles at ibkrquant.com.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.